Hey, we're ready to get started for the August monthly market report. It's hard to believe it's August already. Summer's slipping away. But, every month we try to get together, talk about what the most important things are in the housing market. And we're going to do that this month as well. I'm going to be joined by Alex Rousey. You may have seen Alex on the KCM Instagram. He is the senior research manager, does a phenomenal job with all the research and then helping you understand it. So Alex is going to join us just in a minute, but we're going to be talking about a lot of things. The advantages that buyers have in the market, why they shouldn't wait around for lower mortgage rates, and what investors are up to right now. So with that as a backdrop, we'll go ahead and get started. All right, so let's talk about this. Buyers can benefit from some of the recent seller trends, and that's a good thing. I think buyers right now are frustrated in large by the affordability challenges. But there are good things happening out in the market that we want to be able to share with people. And we'll kind of start here. Jake from Realtor.com said every trend we tracked through the spring carried into June. New listings are up, especially in the Northeast. And asking prices are down due to sellers sort of getting real with what's going on, and that's a good thing. So, I've talked for the last several months, this disconnect between buyers and sellers. We're starting to see this movement. A lot of markets we've talked about have moved from sellers markets into buyers markets. That's a good thing. New listings rose 2.4% year over year in June, closing out the strongest spring since 2022. That's an interesting thing. Now, we've talked a lot about inventory. We've talked about a lot, in it rising and plateauing. But what is true is people are putting their homes on the market at a faster clip in the last several years. Take a look at this. This is June each month. The number of active, not number of actives, but the number of people that are listing their home. If you look at that in June, 463,000 new listings, more than 23, 24, 25, starting to get on pace with the years prior to COVID. Not quite there yet, but certainly we're seeing more and more people say now is the time that we want to put our house on the market. Logan Mohtashami said this: while the Northeast and Midwest remain the most supply-constrained regions in the country, they are posting the strongest inventory growth. In other words, the regions that have historically struggled with inventory shortages are adding supply, while the regions that led inventory recovery are beginning to tighten again. This is interesting. These are inventory cycles. I've been to the Northeast several times this past year, and their biggest challenge has been, if you're in the Northeast, your biggest challenge has been not enough inventory. Prices still rising. Well, we're seeing inventory come to that area, and the South and the West, not so much. Take a look at this. This looks at the percent change in listings year over year. You see the big jump, almost 13% in the Northeast. The West falling in new listings, and sort of very little anemic sort of growth in the Midwest and South areas of the country. This is interesting right now. If you look at inventory, it's probably one of the most telling metrics in real estate right now. You show me a market where inventory is growing, price will be a little bit softer. You show a market where inventory is not where it needs to be or constricting, probably a market that's starting to tighten. That's something that I think every agent right now should pay attention to, is what is happening with inventory. And by the way, then communicating that to those that you're sitting down with. What's that mean for a buyer? What does that mean certainly for sellers in this market? Concern about home prices is definitely rising. This is a look at the share. It's a survey from CNBC. The share of buyers who are concerned about prices, as of the second quarter of this year, almost 30% of buyers say that's my concern. I think about it this way. Sellers want to sell their home and try to get 50 times what they bought it for, and kind of move on. And buyers are ready for a deal right now. In a lot of fast moving markets, if you price your home aspirationally, you can kind of catch the market. But in a market like today, if it's overpriced, it's going to sit, because sellers are looking, they're paying attention, they're watching, and they're ready for a deal on the home that they want to purchase. Realtor.com said summer's officially here and home buyers are jumping into the market, lured by listing prices that are falling at the fastest clip in 9 years. Think about that. That's because sellers are finally accepting a new and slow and steady reality. I think this market, as we start to look at it, being able to communicate this, especially right now, to sellers, but also to buyers, like we talked about. Anybody that's been thinking about buying or maybe been on the sidelines and says, Alex is going to talk about this in a minute, we'll wait for lower rates, or whatever their sort of perspective is, this is something that we want to pay attention to. This is something that I think you can help people understand this market by saying, okay, here's what's going on in sellers and how they're pricing their home and their thought process. Jake over at Realtor.com said asking prices fell again at a record pace, down 2.5% year over year. That's the steepest annual drop in Realtor.com data since 2017, and the 8th straight month of decline. Think about that. That's interesting. Here's what that looks like graphically right here. This is the median list price of June each year, and kind of that run up from 2017 to 2022 when it peaked, and sort of starting to inch its way down in price there. That's, I think right now, these are the things that people need to know about. It's a great topic for videos. It's a great topic to get out in the market, because they're the questions or the things that people wonder that they never tell you about or ask you about. So you want to be able to answer those questions that people have. Zillow, Misha from Zillow said this: the lowest price tiers are exhibiting some kind of softness in terms of price. They also are the most listing activity growth, the first time since 2022 since that's been the case. Want to pay attention out there what's happening in the price tiers as well. Danielle Hale from Realtor.com. Sellers are reading the market conditions and pricing accordingly from the start rather than listing high and cutting later. And buyers are taking note in making bids. This is a welcome sign that we're in a functioning market. I think that is probably the best way to explain it. Is this is a functioning market. And, it takes a little bit of time, maybe some time for it to catch up to sellers. And now buyers are noticing. I think those are all good signs. So listen, I'm going to turn it over to Alex here in just a minute so he can walk you through why, folks shouldn't wait for lower rates, what investors are up to. So hang on for that.
Thanks so much, Dave. It is really good to be here and happy to be with you all for this August monthly market report. Something that we really want to focus on is mortgage rates. Obviously, they've been kind of trending in the wrong direction lately. And we want to go over exactly why your clients should not be waiting for mortgage rates to come down significantly, and also what they can do instead. Let me start with this. We found this really great survey. This is from Best Interest Financial and Clever Real Estate Group. And they asked, this was done 1,000 different participants earlier this year. And they said, what would be a good mortgage rate in your opinion? 63% of respondents said a good mortgage rate is below 5%. Think about that. These are the people that you're interacting with every single day. And a majority of them say mortgage rates aren't good unless we go below 5. What's more, 37% don't consider rates good until they're back in the 3% range. So people have this idea of what is a palatable mortgage rate, what would allow them to move and feel good about it. And it's considerably lower than where mortgage rates are right now. Something else from that exact same survey, they said, okay, well, what do you expect mortgage rates will do this year? You can see here on the screen, 43% of people believe rates will average between 5 and 7% this year. That's realistic. Fortunately, that's the largest share. But take a look at that orange piece of the pie right there. 42%, basically 4 in 10 buyers predict mortgage rates will drop below 5% this year. And then you've got a 16% that say they'll go at 7% or higher. So we've got people thinking that, okay, mortgage rates right now at 6.5 up towards 7 are no good, and I won't feel good about them unless they're below 5. And at the same time, many of them actually think rates will go below 5. So when you put those two things together, it makes sense that some people are out there saying, you know what I'm going to do? I'm just going to wait for rates to come down. I believe they will. They're going to come to a range where I feel good about that. But you and I and people that are in the industry every day know that's not what's going to happen. We look at these mortgage rate forecasts all the time from the experts. Right here, we're looking at Fannie Mae, MBA, and Wells Fargo. And they all pretty much agree that rates are going to stay in the mid 6% range for the foreseeable future. You can see it on this line chart. We're going out to the halfway point of 2027 and rates there between 6.2 and 6.5%. For your monthly market report, you'll get this in the chart form too. So that you can share what the experts are saying, and universally not a lot of change between the forecasters and the upcoming quarters for at least the next year. We're going to stay right about where we are. And so what we really want to go over and what we want to help you be able to explain to your clients and the people that you're talking to this month is, okay, let's set realistic expectations about where rates are and where rates are going to go and not going to go. We want to be able to explain a little bit of why it's not enough just to say forecasters say rates will stay in the 6% range. Let's help people understand why is that? Why should we not be waiting around for 5%? And then once they understand that, okay, that's great to know. Rates are not where I want them to be. What can I do? How can I change my strategy? How can I make homeownership affordable despite the fact that rates are not going to go down? So let's first understand where rates are and why they are not likely to go significantly lower anytime soon. The very best and simplest way to understand this and to explain this during conversations that you're having is this chart. And we've referenced it many times in the past. But this is a look at the 10-year treasury yield. That's the green line. And the 30-year fixed rate. That's the blue line. This goes back like 55 years. They almost always move in unison. So if you want to understand where rates are and where they're going, pretty much the best indicator to look at is the 10-year treasury yield. You also see on here that the average spread between them is about 1.76 percentage points. So if the green line, wherever that is, that's the 10-year treasury yield, say it's at 4. You add 1.76 to that, and that's basically on average where mortgage rates will be. So in that case, it would be 5.76. And so realistically, for anyone to understand and believe that rates are going to go down significantly, we need one of two things to happen. Here's how rates could go down. Either the 10-year treasury yield is going to have to go down a lot, which would bring that green line down and then the blue line would follow, or the spread between them would have to shrink. So that would mean that rates can go down even if the 10-year treasury yield doesn't go down. Let's examine each of those a little bit. The 10-year treasury yield is influenced predominantly, well, it's influenced by many things, but the big things are, where is inflation? Where do we expect inflation will go? And what actions might the Fed take to the federal funds rate based on where inflation is going? And so one thing that most all of us know right now is that inflation has been trending in the wrong direction. This is directly impacting the 10-year treasury, forcing it higher, and subsequently causing mortgage rates to go higher. And it's been trending in the wrong direction. You can see there since about September, October of last year. It really took a spike at the end of February when the Iran conflict started. And since then, inflation has been moving in the wrong direction. That is putting upward pressure on the yield. That's helping mortgage rates stay up. So one way we could see potential relief in mortgage rates and with the 10-year yield is if inflation comes down. But what are the expectations, the realistic expectations for inflation moving forward? Fortunately, the Philadelphia Fed surveys 33 experts and asks them, where do you believe core PCE, which is the Fed's preferred inflation metric, will be over the next several quarters, next year, and into 2028? And when you look at this graph, you're going to see a little bit of good and a little bit of bad. On the positive side, the expectation is that the rate of inflation will come down some over the next couple of years. Ideally, the conflict in Iran will come to a conclusion and we can start to track towards inflation going back down towards the Fed's target of 2%. But what you'll also notice is all of these experts that have been surveyed through at least 2028, inflation will still not get back down to the Fed's preferred target. You saw it back on this slide. What the Fed wants inflation to be ideally is 2% or lower. We haven't been there since early 2021. That's what we're trying to get back down to. And you can see the expectation is we will come back down closer to that, but we're still going to be high. So we've got inflation moving in the wrong direction. We've got expectations that inflation will stay high for the foreseeable future. And so what does that mean? That means that when we were looking at what the Federal Reserve would do earlier this year, saying that maybe they would cut the federal funds rate, that has been flipped on its head since the Iran conflict and inflation going up. And now expectations are that the Fed will probably hike the federal funds rate at some point this year. We're recording this on July 30th. Just yesterday, the Fed met, decided to keep the federal funds rate where it was. But as of today, the expectation for the rest of the year, they meet 3 more times in September and then 2 more times before the end of the year. The expectation is they're actually going to hike the federal funds rate once or twice, and that is an action the Fed would take to combat higher inflation. And so with inflation going in the wrong direction, with expectations of inflation staying high, and with the Fed likely to hike the federal funds rate as opposed to cutting it, all of that is contributing to the 10-year treasury not being able to go down a lot. That is the big reason why experts agree that mortgage rates are not going to go down a lot. And you remember we talked about the 10-year treasury and then also the spread between mortgage rates and the 10-year treasury. Could we get some relief there? Well, take a look at this. This is the spread between the 10-year treasury yield and the 30-year fixed mortgage rate for the past 3.5 years. Back around midpoint of 2023, you can see the difference between those two, green being the 10-year treasury yield and blue being the 30-year fixed rate, was about 3.2, 3.19. So very large. Remember, the long-term average is 1.76, so almost basically double that. That is what contributed to rates being higher back in 2023, even with the 10-year treasury below 4%. Fast forward to today, the spread has been narrowing, and today we're at around 1.9, about 1.88. So that's pretty close to what's normal for the past 55 years. So we've already gotten any mortgage rate help we would get from the spread narrowing. That's already been happening, and we're already back to a normal range. So if we're not going to get help from the 10-year treasury going down because of inflation, Fed's actions, and other things like that, and we've already gotten help from the spread narrowing back to a normal range, how are we realistically going to get back down to rates that are at 5% or lower than that? Here's another way you can look at it and share this with the people that you talk to say, okay, if we had the spread of mid-2023, 3.19, with today's 10-year treasury yield at around 4.67, rates right now would be at almost 8%. Fortunately, the spread has narrowed. If you've ever listened to Logan Motoshami, you hear him say, hug a spread this year. Spreads have gotten back to a normal range, and that's why we have rates today around 6.5, 6.6, 6.7 in that area. If rates were truly at if the spread was truly at its long-term average of 1.76, rates would be only a little bit improved at like 6.43. So we've gotten help from the spread. Realistically, it's very unlikely that rates will get back down to 5% or lower. And hopefully this helps explain why. We put this together, two quick more things on this. What would it take for rates to get to 5%? We picked 5% because in that survey, that's what people said they felt like would be good. And that's what many people actually were expecting. If you wanted to have mortgage rates at 5, you have to have a 10-year treasury yield of about 3.5, which would be considerably lower than where it is now, and a spread of like 1.5, which would be lower than the long-term average and lower than where we're at now. That would get you a mortgage rate of 5. So we went back and analyzed all the data since 1971 and said, how often has the 10-year treasury gotten down to 3.5% or lower? It's only been 31% of the time. So flip that around, 69% of the time in the past 55 years, the 10-year treasury has been above 3.5. How about the spread? Has the spread been 1.5 or lower? Only 24% of the time. Flip that. 31% of the time for the spread, 24% of the time for the 10-year treasury. So putting both of those together, the odds of this happening, the odds of a 10-year treasury going to 3.5 and the spread going to 1.5 are about 7%. Now that's a lot of math. Maybe that kind of could lose some clients. Let's look at this even more simply. And I would encourage you to use this graph in any of your conversations with someone who's waiting for lower rates. This is just reality of what's happened with mortgage rates going back to 1971. About 60% of the time, they're between 5 and 10%. You can see basically all the 1970s, the 1990s, the 2000s, all had rates between 5 and 10%. There's been a little bit of time, basically the 80s, where rates went above 10%. And then there's been a little bit of time, basically the 2010s, where rates went below 5%. So we are in a very historically normal range for mortgage rates right now. And that just further adds to the reason why us getting down below 5%, it's incredibly unlikely. It's happened less than 20% of the time in all of history back to 1971. So hopefully you can use this to understand for yourself why rates are not going to go back down and to explain to anybody why rates are not going to go down significantly. Maybe they'll go down in the lower 6s or something like that, but not going to go back to 5%, much less 2 or 3%. People who are waiting for that, it's just not going to happen. And so you might be saying, okay, Alex, that's great. Now we can tell everybody, don't wait for mortgage rates to go down. So what? Well, if rates aren't going to give your buyers any help and they're struggling with affordability, what can you do to help them? How can you change your strategy? There are some ways to get around rates being where they are with the understanding they won't go down significantly. And we've highlighted 4 of them here. You can explore lower rates with newly built homes. You can ask for seller concessions. You can consider an adjustable rate mortgage, which often comes with a lower initial rate, or look into rate buy downs. A little bit of information on each of these that you'll be able to share with your clients. For newly built homes, check this out. Realtor.com said new builds on the market saw price reductions at a higher rate than existing homes for a second quarter, reflecting demand weakness and active price management by builders to account for it. So builders are lowering prices of newly built homes right now more than even existing homeowners. On top of that, they're offering rate buy downs that enables the buyer of a newly built home to have a pretty significantly lower mortgage rate than the buyer of an existing home. So in Q2 of this year, the average buyer of an existing home had a mortgage rate of 6.47%. In the same time period, the average buyer of a newly built home had a rate of 5.85. That's a fairly significant difference. So for people who are wondering about rates hopefully going lower or needing affordability help right now and not going to get it from rates going down, maybe consider new construction. They could get a lower rate that way. At the same time, seller concessions are a big thing right now. While you might not get help as a buyer with mortgage rates, you might get help from a seller right now. Nearly half of sellers gave concessions to buyers in May, which is the highest May in Redfin's records. 16% of home sales had a concession and a price drop. Here's what this looks like. Basically, half of sellers are giving some sort of concession to buyers right now. That could mean help with closing costs. That could mean a home warranty. That could mean a number of different things to help a buyer struggling with affordability be able to get into that home. So while you may not be able to get a lower rate, you may still be able to get some help from a seller. We talked about adjustable rate mortgages. This was an easy one to pull up. We went to Bankrate and we said, what would have been the average mortgage rate for 30-year fixed mortgages for the past few months compared to the average mortgage rate for a 5/1 ARM? Well, you can see ARM rates are considerably lower and have remained considerably lower for the past few months. That's one benefit of an adjustable rate mortgage. It's not for everybody. It has drawbacks. It should be something that's discussed with a lender. But if you really need a lower mortgage rate to be able to move, you can get one with an adjustable rate mortgage. And so it's worth considering. And so hopefully with all this, you can take this out there and say 3 things. 1, mortgage rates are not going to be going down significantly, certainly not down to 5%, and forget about 2 or 3% anytime in the near future. 2, you can explain why that is the case. It's because of the 10-year treasury and the spread. That's the simplest way to think about it. And 3, you can then help your buyers change their strategy to be able to get into a home despite the fact that rates are going to stay in this mid 6% range for the foreseeable future. Hopefully that helps in your conversations this year. But something else beyond what's going on with mortgage rates, we're trying to help buyers out. We can't give them good news about rates going way down anytime soon, but we can give them some good news about something that's happened recently with big institutional investors. So especially your first-time home buyers, a lot of people have been hearing about investors buying up all the homes, lowering inventory, causing home prices to go up, and just being really unfair competition for first-time home buyers. And with recent legislation that's passed in Washington, that's in the news again. And there's some very good news on this front to be able to share with buyers that maybe can help them step into the market as big investors are stepping out. Let's take a look at it. From Redfin, U.S. investor home purchases fell 6% year over year in the first quarter to their lowest level since 2020, when the start of the pandemic ground home buying to a halt. Prior to 2020, the last time investors bought so few homes as they did in the first quarter of this year was in 2016. Here is what that looks like. You've got investor home purchases by quarter going back to the start of 2000. And that blue line there is Q1 of 2026. And you can see that it's the lowest since 2020 when we had that one blip right there, thanks to the pandemic. And to find another quarter where investors bought so few homes, you do have to go back to 2016 there. So investors really aren't the competition right now that many buyers have been feeling like they are. Why is this happening? Two big reasons. The first is that legislation that I referenced earlier. Here's a quote from Cotality. When Washington announced its intention to curb institutional investors' home buying, the market reacted. Although that ban had not taken effect at the time Cotality said this, it since has taken effect. Cotality data shows that investment by mega investors, big Wall Street investors, had retracted almost instantly. So there is some positive news. This bill that has now been signed into law has now become law. We have investors, especially the large Wall Street investors, pulling back on their purchases. Another reason why they're doing this is the market is just cooler now than it was. You think about this just logically, investors are trying to make money. And so if they can get into the housing market and turn a quick profit, if prices are rising dramatically, that's a good way to make money. If that's not happening, when prices aren't rising quite as fast as they were in the past, maybe there are other avenues that an investor the rent they can charge is not going up like it was. Holding costs for these homes are high with property taxes and insurance. Capital markets have shifted their attention, and elevated material prices for investors that want to flip homes make renovations expensive. So that's part of the reason why investors are buying fewer homes right now. But we could take it a step further than that. Information from Parcel Labs and Resi Club shows us that the 8 major institutional landlords in this country are actually selling more homes than they're buying. And the gap is growing. Look, this is going back to the start of 2025. Every single quarter, these major investors have been selling more homes than they're buying. And just this last quarter, they sold 3,000 more homes than they bought. So not only are investors buying fewer homes, they're actually selling more than they're buying. That means more options on the market, more inventory coming on the market for potential buyers. That means lowering pressure on home prices, thanks to more homes coming on the market for buyers. And that means not having to deal with the competition of these big investors who can buy all cash and price people out of the market. Put simply, this sudden drop off in institutional investment is a signal to first-time home buyers that there is an opening. So as you're having conversations over the next month, hopefully what you can say is, hey, maybe mortgage rates aren't going to go down a lot, but I can help you get around that. And oh, by the way, we're getting some good help from these scary big investors that you've been hearing about that you thought were buying up all the homes. They're actually making things a little bit easier for buyers right now, fortunately. All right, that's a wrap for the August monthly marketing report. Thank you so much for joining us again so that you can stay up to date on what's happening in the market and best explain that and have conversations with your clients. Thanks to Dave, as always. Appreciate having me on as well. We look forward to having you back here when we do it all again next month for the September monthly market report. Until then, go out there, have a lot of great conversations, and we'll see you next time.